Today, federal prosecutors seized nearly $700 million in cash and assets tied to Sam Bankman-Fried. Former Genesis executives claim to raise millions for a new hedge fund. And Brian Mosoff of Ether Capital discusses his outlook for Bitcoin's rival. Welcome to CNBC's Crypto World. I'm Kate Rooney. Digital currency prices are mixed to kick off the week after coming off big rallies over the weekend. Bitcoin crossed above $23,000, but as of noon Eastern, was trading right under that mark at $22,900. Ether, meanwhile, mostly flat this morning, but trading close to $1,600. Solana also on the rise, jumping to $24. 2023 so far has brought huge gains for Bitcoin, with the cryptocurrency rising nearly 40%. Since the start of this year, investors see inflation easing, which could lead central banks around the world to shift monetary policy, and that is seen as good news for crypto. Okay, let's talk about some of the top stories. First, federal prosecutors seized nearly $700 million in cash and assets connected to Sam Bankman-Fried, mainly in the form of Robinhood shares that were owned by the disgraced former crypto executive. That's according to a court filing revealed on Friday. The more than 55 million Robinhood shares are the focus of a battle between Caribbean litigants, representatives of bankrupt crypto lender BlockFi, FTX's bankruptcy leadership, and SBF himself, who wanted to use those funds to pay for his legal bills. Federal prosecutors have alleged that the Robinhood shares were purchased using stolen customer funds. SBF was arrested on criminal fraud charges last month and has repeatedly denied misappropriating customer assets. 3 of the seized accounts were held at Silvergate Bank and held more than $6 million in the name of FTX Digital Markets, a Bahamian subsidiary. Next up, former executives for Genesis claimed to raise millions for a new hedge fund just as the crypto lender headed for bankruptcy. According to messages reviewed by CNBC, Matt Ballensweig, who's the former head of institutional lending at Genesis, sent a message to a prospective investor regarding a fund called Hunting Hill Digital. Ballensweig said that the fund had secured $2.5 million in funding from Bessemer Venture Partners, but Bessemer told CNBC it wasn't an investor in the project. Legal filings for Genesis's bankruptcy claim that Ballensweig falsely reassured Gemini in July that Genesis was financially stable. Gemini claims he said Genesis had the capital to operate for the long term. Other partners in the fund include Martin Garcia and Reed Werbit, both former employees of Genesis. Ballensweig did not respond to CNBC's request for comment. Last up, Ethereum's co-founder Vitalik Buterin shared a possible solution to the privacy challenge for Ethereum, a concept called stealth addresses. In a tweet on Friday, Buterin provided an incomplete guide to stealth addresses, which he argues will make peer-to-peer transactions anonymous, and in this post explained how they can be carried out. Stealth addresses are one way developers have looked to address privacy concerns on blockchains, and it's not the first time Vitalik's proposed them. In August of last year, he suggested the feature as a way to incorporate privacy into NFT transactions, but he admits the technology could lead to new problems for the network, like much higher gas fees. Sticking with Ethereum for our main story, Crypto World's Talia Kaplan spoke with Ether Capital CEO Brian Mosoff about his outlook for the network, competing layer ones, and his recent move to allocate additional Ether to staking.
You're the CEO of a public tech company with a focus on yield generation and building infrastructure to support the Ethereum ecosystem. Why was it important for you to be involved in a business like this, and how does it work exactly? How are you able to generate yield?
Our company has been focused on Ethereum since day one. We've been excited about the crypto industry. We're a blend of crypto natives and members from traditional finance. And we see that this is going to be a very important piece of the internet, and the future of a lot of financial transactions will get tokenized and exist on a blockchain. And we think that the cornerstone of that activity is going to be Ethereum. Now, in the last couple of years, you've seen a lot of activity emerge on Ethereum, some of it being crypto native, DeFi, NFTs, the metaverse, and then stablecoins, real world dollars getting tokenized and using this as infrastructure. And we think that more of this activity is going to continue. So that's the reason to focus on Ethereum. Now, The blockchain has been secured historically through something called proof of work. Many people are familiar with the term mining. This is computing hardware, being put up, spending a bunch of electricity in order to validate transactions. And recently, Ethereum has transitioned to proof of stake, where you could lock up the native token, Ether, into basically a bond with the software and generate yield that way and help secure the network. So we see that as a really exciting opportunity. Ether Capital, I think, is the first in the capital markets to stake. We have about 28,000 Ether doing so. And we think that there's going to be more institutions who look like us in the future. And there's a lot of infrastructure to be built around that technology.
What do you plan to do with the yield you generate?
So we're a long-term believer in ETH. I know that the price has retracted in the last year. And so a lot of people are shying away and wondering what's going to come of this asset class, ETH, Bitcoin, perhaps other layer ones. But we still think that there's a lot of room for these assets to grow. So we want to be a net accumulator of ETH. We want to continue to add to our position. And then we can use some of that yield to pay for software that we think needs to be built. Because we're public, that comes with a different set of standards in terms of disclosure obligations and reporting. We have to meet certain things with our audit firm that at times can be challenging, but that also presents an opportunity that, again, we see the world in a very specific way, different than a crypto native who's just holding these assets on a hardware device or a piece of software. They may not have the same reporting obligations and monitoring requirements that we do. So we can use a portion of that yield to build out software, again, to help more institutions who are going to start building a position in this asset in ETH and want to stake it, make the asset productive, and help decentralize the network and help secure transactions that are taking place.
Earlier this month, you announced that your company has allocated an additional 7,488 Ether to Ethereum staking, bringing your total staking balance to 28,000. That represents 62% of your portfolio. How much more are you looking to stake, and what are you hoping to achieve by doing this?
I think anyone who's sitting on ETH and taking a long view of what the asset's going to be worth 3, 5, 10 years out is going to want to make it productive and, again, generate some type of return. Now, the return on the low end may be 3%, it could be 5%, it could be 7%. It really depends on a number of factors, such as how many other participants there are on the network that are also staking, how many transactions are taking place, what that activity is. So no one really knows what the yield is going to be. It's all speculative. But the point is that for those who are sitting on a large treasury of ETH, why would you not take advantage of that opportunity to generate revenue along the way? So for us, we would love to get to 95, as close to 100% of the portfolio that we can, locked up staking and helping validate transactions on this network. Currently, there is no liquidity on staked Ether. That hopefully will come in the next few months. It doesn't matter for us, but I see no reason for those who are not looking to trade the asset to put it in a DeFi protocol. They should be locking it up and they should be staking and taking some return. It is paid in ETH. It's not in US dollars. They should be taking that along the way.
The massive overhaul to change Ethereum from proof of work to proof of stake finally happened last year, and it has been about 4 months since the merge. What do you think has changed since then with regard to Ethereum, now that the network uses validators who have staked Ether to certify transactions? Would you say the transition to proof of stake did in fact make the network more secure?
Well, one thing that happened certainly is the amount of energy that is used to validate this network has been reduced by over 99%. That's a huge deal. While you have a big narrative happening globally around energy consumption of proof of work mining and how much Bitcoin consumes in terms of its validation. So that's fantastic on its own. The other thing is that block times now are more consistent. So before, if you submitted a transaction, it may take place within 10 seconds, maybe it would be 15 seconds. Now it's more predictable. It's a very steady, even 12 seconds. And you've democratized the access of who can stake, who can generate this yield, and who can help secure the network. Proof of stake is more democratic. It doesn't mean that it's perfect. It doesn't mean that it's as decentralized as it can be yet. But I think as tooling continues to evolve, more people are going to be able to participate in validating these networks. And that's a great thing.
So for years, you have held the view that other layer ones won't replace Ethereum. Can you expand on your thoughts on those competing layer one blockchains like Solana, for example?
Yeah, I draw on this idea that Peter Thiel has a very famous book in the VC community called 0 to 1. And the idea is that something like Bitcoin invents a new category. It invents cryptocurrencies, it invents blockchains, and everything that comes later. And so people rally around these 0 to 1s, these inventions of new categories. And in the early days of Bitcoin in the 2012, 13, 14 era, you saw people try and clone this open source code that exists on websites like GitHub. And they said, we're going to make it cheaper and faster, and it's going to be used to do a certain thing. But it wasn't really that much better than Bitcoin. It was just a bit of an optimization. And so now that we have Ethereum inventing a smart contract platform set of tools, you're hearing the same narratives again, that people are going to take that code and they're going to make it cheaper and a little bit faster. And that's not enough to unseat the developer community, to bring that intellectual capital to build on some other set of infrastructure. Doesn't mean that some of these other blockchains won't exist in the future. It's just that the best mind share is rallying around Ethereum. And that's where companies like Ether Capital, ours, remain focused. We want to be where the best developers are, where the most things are being invented. The most stablecoin activity is happening on Ethereum. Uniswap, the biggest way to trade on-chain on an actual protocol, that again is invented on Ethereum. A lot of the NFT activity invented on Ethereum. OpenSea, the way to trade NFTs, again, is being invented on Ethereum and then ported out to other layer ones. Now that we have scalability coming through the form of layer twos, these are kind of like sister networks that leverage Ethereum's base layer for security. I'm not really sure what happens to blockchains like Solana and Polkadot that are trying to compete with that developer activity, because if we need cheaper and faster and more scalability, you can do that inside of the Ethereum ecosystem. So it doesn't mean that these things won't exist. I just think that there's a lot of easy headlines that people see calling things ETH killers, and I just don't see that playing out.
Okay, that's it for Crypto World today. We'll be back again tomorrow with a lot more. We'll see you then.